Hello, I'm Tai Hui, the Chief Market Strategist of Asia Pacific at J.P.Morgan Asset Management, and welcome to our series of videos discussing the economic and market outlook for 2022. Now, in our last video, we discussed the global economic and political outlook and China's growth prospects. In this video, we'll discuss in more detail the inflation outlook of the US and the Fed policy. So one of the questions is, when will inflation come down? Now, the inflation challenge varies depending on which economy we're referring to. For example, consumer price inflation has been stubbornly low in China, even though producer price inflation has been rising. In Europe and Japan, their central banks still see the recent pickup in inflation as transitory. Given the influence of the US Federal Reserve on the global investment markets and that inflation seems to be more of a challenge in the US, it is worth considering if inflation would ease in 2022. Some elements of inflation spike are indeed transitory. For example, higher energy prices are feeding directly into gasoline and transportation costs. In the near term, oil price risk remains on the upside given OPEC's reluctance to increase output. Yet, the long-term demand and supply balance should limit how far energy prices can rise. This means that inflation impetus from energy costs should fade in 2022. However, rent and housing and wage growth could create more persistent inflationary pressure in the long run. On wage growth, rising inflation expectations and worker shortages could also lead to companies raising their products' prices. Overall, we expect headline inflation around the world to come off the 2021 high, but the undercurrent of firmer inflation could continue. Likewise, inflation in the US is expected to come down from 5 to 6%. However, given the strong recovery momentum and some supply-side and labor market distortions, core inflation could remain above the Fed's target of 2% for much of 2022. The next question is, will the Fed start raising interest rates in 2022? It is possible that the Federal Reserve could choose to raise policies before the end of next year. The precise timing of the shifts will depend on how inflation and the job market behave in the next 12 months. A growing number of FOMC members are predicting the Fed may need to raise rates before the end of next year. It is important to consider the Fed's policy objectives of price stability and full employment. As we mentioned earlier, headline inflation should stay slightly above the Fed's 2% long-term inflation target. In terms of full employment, the US latest unemployment rate is at 4.3%, and this should gradually decline over time. Demand for workers continues to be strong, with over 10 million job openings as of August versus 7.7 million unemployed people. The low participation rates and disconnect between demand and supply could be due to COVID impacting on workers' decision to seek job, as well as demand for higher wages, and also an increase in those opting to retire from the workforce. Overall, the Fed's own projection of unemployment rates falling below 4% by the end of 2022 seems realistic, and this would imply the US job market is back to full employment, especially if wage inflation remains stubbornly high. The pace of policy rate increase in the next 2 to 3 years is arguably more important than the timing of the first hike. The Fed's median projection suggests that around 3 25 basis point hikes each in 2023 and 2024, hitting 1.8% by the end of 2024, with long-run rates at 2.5%. Overall, this would be a gradual rate hike cycle compared to history and should not be a threat to economic growth. This will also imply that policy rates could remain below headline inflation for an extended period of time, prompting the need to search for income. Thanks for watching. In our next video, we will discuss asset allocation, outlook of the equity market, and how to generate income. If you want to get the latest copy of our 2022 year ahead, please reach out to your J.P.Morgan Asset Management client advisor.